And welcome to our end of March update from the Wealthy Doctor Institute. Physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with their current investment strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. Although the strategies in this book are easy to calculate each month, for those of you who are new to the concepts of the book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So this month we'll cover our safety belt systems, then we'll go on to the momentum rotation systems and how those flesh out our safety belt systems. Then we'll review our free sector surfer strategy that we're monitoring for illustration, because we do use Sector Surfer, and when you sign up for Sector Surfer, you do get a choice of both free and premium strategies, or build your own. Then we'll remind ourselves about the rules for the stock tip strategy. So we have a lot to cover, so let's get going. Reviewing our systems. We'll start off with our stock market safety belt. Now in my book, I describe the 20-month simple moving average system, otherwise abbreviate to 20-month SMA. Think of this as a safety belt for stock market investing. It doesn't guarantee against all losses, however, it does increase our chances of survival during a major stock market crash. So here's an example. If the price of an index, in this case we're using the S&P 500 Index Mutual Fund, is above the 20-month moving average, then it's relatively safe to stay invested in the index fund. Otherwise, get out. Remember, as with any other systems, the 20-month moving average only works if we consistently watch it every month. So here's a graphical representation of how this works. We have two lines. We have the blue line, which is jaggedy. This is the S&P 500 Index Mutual Fund reinvesting dividends. And here we have the red line, which is our 20-month moving average. You can see how historically, when the blue line stays above the red line, it is relatively safe to be in the stock market. But as markets wiggle up and down, when it wiggles so much that it goes below the red line, it tends to go down for months to years. And that's when, statistically, we can catch potentially large bear markets early enough to make a difference. And so for this month, we take a look at the price of the S&P 500 Index Mutual Fund, which is $261.56 per share. Then we calculate out the 20-month moving average, which is now $246.87, so both are increasing. And just for our number geeks out there who like this stuff, we can divide and find ourselves a 5.9% cushion. In other words, by next month, if the index goes up, stays flat, or even goes down less than 5.9%, it's likely that we're still within the safety zone. However, if we check next month and we find that the stock market index mutual fund is below our safety belt, then that's a dangerous sign that tells us we need to get out. So for those of you who have been following my videos so far, you know that a couple of years ago I discovered Sector Surfer, which is another sector rotation system. And Sector Surfer has a safety belt called Storm Guard Armor. It's a filter that is more sophisticated than what I calculate. It triggers somewhat more often than the 20-month moving average, usually triggering approximately 1.5 times per year instead of once every 3 years, and at least historically has been able to smooth out the growth curve better than my 20-month moving average system. So let's look at this month. This past month, the S&P 500 index has been going up. The red line exactly parallels the white line. The red line representing the mutual fund exactly parallels the white line index reference line, which means that we've been staying in the stock market. And just to take a look at the actual Storm Guard Armor indicator, we can see that Storm Guard Armor is again just barely positive. This time it's 0.10%, not 0.05%. All we have to do is know that as long as this number is positive it's relatively safe to be in the markets. Otherwise, we'll be on the lookout next month to see if this stays positive or goes negative. So now we go on to our next system, the monthly rotation investment systems. In my book, I described my system and abbreviate to MRI. And for those of you who follow my videos, you know that I no longer follow my MRI system, now that the algorithms of Sector Surfer far surpass what I could do with Excel, pen and paper. So the Sector Surfer version of MRI used the same three funds as my book, the S&P 500 Index Mutual Fund, the Emerging Markets Fund, and the Inverse Index Mutual Fund. Again, long-term followers of my videos probably know I no longer even follow the Sector Surfer version of the MRI. But I will still cover momentum rotation systems and why it's important. So, for instance, when we're given choices of large cap, small cap, intermediate cap, domestic stock mutual funds, real estate mutual fund, international emerging market mutual funds, and bond funds, if we were to rotate these funds, trading approximately 4 times per year, we would be able to somewhat improve our momentum so that not only do we mitigate or completely miss the major bear markets of 2000 and 2007, but we might also be able to make money during that time. But over the years, when I've been evaluating this, I find that if you use any kind of rotation system without some kind of safety belt system, our systems tend to be more jagged, in other words volatile, and tends to have longer periods of flatlining. So one thing we can do is to separate out the stock from the bond funds. Use only the stock funds when Stormguard Armor indicates that it's relatively safe to be in the stock market. Otherwise, rotate only through the bond funds. And so here's what happens when we do that. When we rotate only through stock funds during the safety portions of the stock market cycle and rotate through the bond funds when it's dangerous, here's a much smoother graph, which at least in the past decreased risk while letting the winners ride. So the next system is us monitoring a sample-free strategy that comes with Sector Surfer. Remember, when you sign up for Sector Surfer, you get a free account. If you want to use one of the free strategies, there is no fee for using those free strategies. However, they do come with weaknesses. They're not exactly optimal strategies. If you want to modify those strategies or build your own, or subscribe to one of their premium strategies, you may perform better. But what the heck, let's at least follow along with free strategy. So the free strategies in general use generic asset class funds. They use an older version of Stormguard. They do not separate out stock from non-stock funds during the rotation, but at least it's free. So here's an example using the free strategy called My ETF Asset Class. Notice you have so many ETFs representing large cap, mid cap, small cap stocks, growth and value stocks, and you're rotating through these stocks when it's relatively safe to be in the stock market, and then you're going to cash when it's dangerous. So by doing this free strategy, you'll, at least in the past, have gotten this yellow line, and you can tell how when we were in cash, we were relatively flat, like here, and portions here, which happens to correspond to when the stock market itself was dangerously declining. Now, the free strategy has given an annualized return of 15%. Again, past performance does not guarantee future results, and if you like the performance of this particular strategy, it's free. The next system is a stock tip strategy. The stock tip strategy is when you absolutely positively must buy a particular stock for some strange reason. So, if you want to buy a stock, I do not suggest buying a single stock because stocks have this one weakness that funds and ETFs do not have, and that is if you have stock-specific news that comes out overnight, and they typically tend to be bad news, your stock would likely gap down overnight, and our rotation strategies cannot protect against that. So, if you absolutely positively must buy a stock that you, for some strange reason, love, and I don't suggest buying any stock you love because then your emotions are just involved in that trade, then you don't want to risk more than 1% of your total portfolio or trading account on any one stock. So here's how we do this. You can use up to 4% of your trading account to buy that stock and then immediately enter a 25% trailing stop loss order. Now at this point, the stock can do one of two things. Eventually, it can either go up or go down. If it goes sideways, it eventually has to make a decision whether or not it's going to go up or down. If the stock goes up and goes up 33%, you can go ahead and buy another block of stocks using another 4% of your account, and then update your trading stop loss order to reflect the increased number of shares. And just keep on repeating until your stock finally starts to go down enough that it stops out when it crosses below the trailing stop loss. So this is just a summary of what we've talked about so far. We reviewed our basic systems, namely first our safety belt systems, and then we reviewed our momentum rotation systems and how integrating momentum rotation systems with our safety belt systems, we can improve on our overall investment strategy, keeping in mind that no system is perfect. There's always a chance of loss. Past results do not guarantee future performance. And then we continue following our example-free sector surface strategy. This month there has been no trade alert. And then we went over our stock tip strategy. Okay, keep those questions coming. I know I talk to several of you personally each month, and I realize that for some of you, these video updates are not enough, especially if you're still unhappy with your current investment strategy or lack of strategy. I'm going to offer a complimentary investment wellness checkup session for you. Just you and me, ask all the questions you want, no matter how seemingly basic or clueless you think you are. In our checkup session, we'll together create a sense of clarity about the financial future you really want, the reasons why you're investing to begin with and how to get you there, discuss in basic investing building blocks that are more specific for your situation, determine what has stopped you in the past from getting what you want now, and identify what are the most important steps you need to take now to get to your investment financial goals. Think CME, only this is financial. Think wellness checkup, because whether or not you feel financially well, if you had a financial cancer or blind spot you didn't know about, wouldn't you rather at least know so you can deal with it before the problem grows and metastasizes? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely.